Hi, welcome. This is Moses Gumadi. I'm the director of ROIC Consulting. ROIC Improvement is one of the foundational offerings that we provide to our clients. ROIC is emphasized across all our other offerings as well because it is such an important metric that every organization, every business must measure and try to improve that particular number. Now, in this presentation, I want to cover a few things. Why improving ROIC is important. What are the typical client situations when ROIC improvement becomes important? And what are the key steps in the ROIC analysis, and what is the approach we take to make ROIC, to improve ROIC, and how the client can benefit. So first of all, what is ROIC? ROIC is return on the invested capital. The invested capital is in the bottom of the equation, which is a denominator, and the return is essentially the NOPLAT, the net operating profit less adjusted taxes. Net operating profit less adjusted taxes, which is equivalent to profit after tax, but slightly more nuanced. In the case of operations, you need to ensure that certain things, certain adjustments are done. So NOPLAT is almost like profit after tax, but let's be technically correct, it is NOPLAT. Okay, now, so we use EBITDA number, and then we apply the tax return, tax rates, and we get the NOPLAT. Invested capital constitutes both property, plant, and equipment, PPE, plus the working capital. Of course, you focus on the operating assets and minus operating liabilities. I'm only talking about the operations at the moment. So if you consider this, right, what you calculate in the end is the ROIC, return on the invested capital of your operations within the business. Now, why is ROIC important? First of all, ROIC is the most efficient way to measure the productivity of business operations. Okay, the most efficient way. Okay, this is the number that you want to improve. Okay, any other number which you might be seeming to improve, but it turns out that there is no making any impact on the ROIC or trying to reduce the ROIC in any way, then that is not really a good thing to do, and therefore you must improve ROIC. Secondly, higher ROIC means increased market value. If your company is a publicly traded company, basically it will improve your market value, share price, right? Even if it is a private company, shareholders get higher returns. Shareholders get higher returns with an improved ROIC. And if you are planning to sell a business later on, you want to improve the business and sell later on, what you're trying to achieve here is to improve your ROIC. Your business can be sold for a higher price. Thirdly, in practical terms, higher ROIC simply means that you get more revenue, more profit after tax, with low working capital, and you'll have freed up cash. That's what it means, at least two or more of them. Okay, and finally, if your ROIC is less than the weighted average cost of capital, then you will end up draining the value of your business on a daily basis. Okay, therefore you must measure what is your ROIC and where are you, and what's your plan to keep on improving year after year. Okay, ROIC drives long-term value. Okay, this has been established empirically, and in that particular book there I have shown comes from McKinsey, guys, and it's a textbook, for God's sake, for many MBA courses, and actually done not by a university but by management consultants, top class guys, McKinsey folk, and they have collected a lot of data in the past to show very clearly that ROIC indeed drives long-term value of the businesses, of companies. Okay, so what are the routes to ROIC improvement? How can we go about improving the ROICs? First of all, free up wasted capacity in your operations to increase the output. Okay, secondly, if you're efficiently scaling up operations to increase the revenue will obviously improve your ROIC. Reducing the inventory, working capital, etc. can help. In fact, not just can help, it will massively help to improve ROIC. Shortening cash conversion cycles, and that includes lead times as well, will improve your ROIC. And finally, reducing costs by effective utilization of resources or by any other means. If you can cut down the cost without impacting other parameters, right, you can improve ROIC as well. So these are the typical client situations in which we help our clients to improve their ROIC. First thing is that they have no ROIC baseline, or they don't know their relative performance in the industry. Secondly, their ROIC is poor and they don't have an existing turnaround plan. And another scenario is where they have poor ROIC, right? And they have some initiatives, they have some projects, they're planning or underway, but they do not know really what is the impact, what's the real impact of those projects on the ROIC. Also, in a poor ROIC scenario, people are looking to scale or have already started investing in scaling the operations to grow these operations without really working on improving the ROIC. And if that is the case, it is a very difficult position to be honest. Okay, because if you try to grow a company which is draining value, you end up draining more value. That's dangerous. Good ROIC. If you are in a good ROIC position, but you are unaware of scaling opportunities, that is another case where we could do this ROIC improvement offering, right? So, and finally, a good ROIC situation, your scaling plans are there in place, but you want to evaluate what's the best combination of scaling actions in order to get to that maximum ROIC position, right? So, what are the key steps involved in performing this ROIC analysis? We do a ROIC tree analysis. So we model a ROIC tree, we do sensitivity analysis, and finally figure out a target position to which you should aim to reach. Okay, that's what we do. This is simple. Well, there is more we can offer, but in this particular offering, we do the analysis, we do the modeling of a ROIC tree, we do the analysis and find out the key parameters and develop a target position. So what is ROIC tree modeling? We essentially create a map like this with all these boxes, the connected boxes with all the numbers, financials, and the financials are linked to the operational KPIs. Okay, each box has two numbers, the top number being as is and the bottom number to be number. So you can compare as is to be at any given point in time. This is done on a proprietary software, and you change any of these values, you can immediately see the effect on the other side in terms of the ROIC. But this is not all. This is just a starting, right? So what we then do is to find out the levers that will help you increase the ROIC. What are the levers that you really need to move in your operations that will make significant difference? And how do we find these levers? By performing a sensitivity analysis. We, using the same software, run the sensitivity analysis upon that ROIC tree, right? So we put in a range of values for all these KPIs, and for a given percentage, if 1% of a change in the KPI, how much percentage in ROIC will it impact, right? So that's what we find in one shot. Right, so we get this is the final analysis. We put in obviously a lot of numbers in there, and then this is what you get. We now know which are the levers that are most effective in order to move ROIC from your current position to an improved position. Using this information, and of course interviews and a lot of ground reality as to whether or not some of these can be changed and what is the investment involved and the rest of it, we will then try to develop a target position. We'll come up with multiple scenarios, possibly. We'll analyze these, and we can, with your agreement, finalize a target position to which you can plan to reach. Right, so this is a sort of an end deliverable for this particular offering, but we have more to offer as well, as I will explain. So now let's talk about the approach to ROIC improvement. So we have 4 simple phases. First of all, we develop a high-level ROIC tree, right, for just the financial part of it, right, at a very high level, and find out where are the opportunities. Is it in the revenue side, is it in the cost side, or is it on the balance sheet side, or is it in the inventory? Where exactly is the major problem lying? That will give us a bit of a sense as to where we are, right? And then we start linking the high-level ROIC tree to the operations by by developing further the revenue structure, the price of volume profile, etc. We develop a cost structure, cost categories. We develop the structure of the capital situation, and finally figure out various operating levers in your operations and tie them up to this whole map. Right? Once this is done, we determine the levers of the ROIC. We develop a detailed tree with the operational KPIs and then perform a sensitivity analysis to determine those particular KPIs which you can play with in order to move your ROIC up. Right? And finally, we develop what-if scenarios, evaluate existing projects and initiatives and plans that you might have, and freeze on a mutually agreeable, right, target operating position. That's the output, a target operating position to which then you can plan to reach. Additionally, we can help you develop a path to get to the target operating position. Also, we can help you to implement that particular plan. So this is an additional offering. So essentially trying to improve the ROIC. Now, if you have a target operating position, let's say, what is the benefit? What can you do with a target operating position? Firstly, it will help you create a viable plan for turning around your business or to scale your operations. Secondly, it will provide you a robust basis to raise capital. You can go to a bank or to an investor, right, for improvement and growth opportunities. And thirdly, it will help you to reprioritize existing projects, existing initiatives for a maximum ROIC position. And finally, it will help you in decisions to sell or close when the business can't be fixed. So thank you for stopping by and watching this presentation. In case if you like my help, please get in touch. Click this button below this video or try using these contact details and get in touch. Thank you very much.